Well, Happy New Year, everybody. Today is Friday, January 6th, and my name is Ted Greene. Thanks for logging in online, and for those of you that are here in person, we appreciate your taking a few minutes to come. Let me first of all cue up just a little bit about what we're trying to do here at Spartan Investment Group. Spartan is a syndicator or a purchaser of commercial real estate. Self-storage assets is our preferred sandbox to play in. We raise investor dollars, put those dollars to work in an asset that we've acquired. We run the company. Our full-time employees are the only people that touch the company, either by way of operations or accounting or construction or investor relations here in the Seattle, Washington office. We have a little bit over 100 employees. There's about 9 of us here in Seattle, and that's our hustle, so to speak. Our focus here with the First Friday events is, from my perspective, an attempt to help investors get their arms around the following: understanding the risk of an investment, evaluating the risk of an investment, subsequent to that, putting risk to work in their portfolio. The stock market can be really challenging, really scary. My background is on Wall Street from the days of Seattle Pacific University here in Seattle, just down the street. I did an internship starting in 1991. That led to 24 years as an investment advisor. Most of that time at Merrill Lynch. I can tell you there's a lot of anxiety that goes along with the stock market. And as investors attempt to understand, evaluate, and then put risk to work in their portfolio, bantering back and forth respectfully, trying to understand what risks exist in various investments, that's really what we're trying to do here at Spartan, is to build a strong community of investors who are engaging, working together to process what risk is there in the marketplace, and then how to employ that risk to their benefit. This is not tax, legal, or investment advice. We're not registered in the marketplace as an investment advisor, nor as a tax advisor, nor as an attorney. So, of course, do your own due diligence. People listening online, if we field questions during my brief presentation, they won't be able to hear, so maybe it's best to hold any comments, observations until we conclude, and then we can engage in some dialogue, and that's, from my perspective, that's the funnest part of the day. Understand, evaluate, and put risk to work. Who is a good member of the community from our perspective? People that have significant assets that they're trying to put to work. So if you've made a transition from a former employer to a new employer and you have an IRA or a 401k, I have a background in self-directed IRA accounts. I sold the company to Yield Street in 2019. SD IRAs, solo 401ks, EQRPs, that's my jam, so to speak. So happy to talk with you on those topics. And if you know of somebody who's recently made a transition, I think that's a good target, a good person who might have an interest, because so far the stock market is challenged the last year. I'm not so sure that all of that is done. And so just don't lose track of the notion that there's pockets of money sprinkled around where a $25,000, a $50,000 investment in a multifamily investment, an industrial, a cold storage, a self-storage, there's a lot of merits to that. I'm going to transition and turn you into gearheads for a few minutes, because nerds like company, so come join me in some nuanced dialogue. I'd like to talk about the bond market for about 10 minutes. This might hurt your brain a little bit because it is so off in the left field, but let's lay a foundation, and throughout the next 25, 30 minutes, we're going to build on that foundation by way of increasing our knowledge, understanding, is in providing tools, I think, to help understand and evaluate risk. The bond market is critical, in my impression, or from my understanding. Understanding the bond market is critical to be able to both understand and evaluate risk. So here goes a crash course on the bond market. Thinking in terms of the U.S. government and what the Treasury market actually is, Treasuries, generally speaking, sell in increments of $1,000. Yeah, you could have a zero coupon bond, which strips off the coupon, and so it's going to sell at 88 or 92, what have you. But generally speaking, bonds sell in increments of $1,000. The coupon is fixed. The yield is not fixed. Oftentimes when folks are conversing about this type of a market, there's an unintentional slip of terminology. So it's important to tattoo on our brains that coupon doesn't change. The yield is going to change because the value of the bonds are marketable, they sell intraday. It's a huge market. My understanding is that the bond market is a deeper market holding more volume than the stock market. That's a big statement right there. So fluid and marketable is the takeaway there. So the coupon is static, doesn't change. The market value can be above the $1,000, that's a premium. It could be below, that's a discount, but lots of activity, and the yield, based on the valuation change, the yield will change. You hear people talk about the yield curve. We're going to start at the very basics and just flush out in the next 2 minutes what is the yield curve. So starting from the left axis, time gets further out the further to the right we go. Yield goes higher the further up the y-axis we go. And this is a look back from 2019, and this is a yield of 2.5%. And I'm for those of you online, I'm looking at the left side of the chart on the y-axis. This is 2.5%. This is 1%. This is 0 by way of rate of return. By way of time increments, this chart is a little bit wonky. Give me the hall pass if you would, please. This is 3 years. This is 5 years. This is 30 years all the way out here. So in subsequent charts we're going to look at, it's going to be a little bit more condensed, where the 10-year mark is here, et cetera, et cetera. But at any rate, yield going higher, time going further out in time, going this direction. Now let's do a quick mental exercise about what yields on bonds and market values on bonds might do. A bond issued 10 years ago that is a 20-year bond now falls on the 10-year part of the curve. Let me say that again. A 20-year bond subsequently turns into a 10-year bond 10 years after it's issued. We could restate that a whole bunch of different ways. A 10-year bond issued a year ago is now a 9-year bond, et cetera, et cetera, et cetera. So if we think back over the last 20 and 30 years, the interest rate environment from 2007, which I should have thought this through in advance, but I think 2007 was 16 years ago. So a 30-year bond issued in 2007, which in retrospect probably had a coupon, a 30-year bond issued in 2007, I think probably had a coupon of 5 or 5.5%. In the last 16 years, who would have thought that the highest yield for a treasury bond would have been 16 years ago? I mean, in 2007, looking forward 16 years, would we ever have thought this kind of an economic environment would come about? I mean, no. I mean, it stands to reason, generally speaking, economic crises don't repeat themselves. I mean, history may rhyme sometimes, But usually in economic crisis, it's a new thing. There's something different, and we're going to get into that here in about 5 minutes. But anyway, bonds that are 10 years at issuance, 1 year into it, that's now a 9-year bond, and you're going to just intuitively know where the yield on that bond is by looking at a chart. Now, the next few minutes, we're going to be, I'm pulling data that came from one of my favorite my favorite websites. See what I did there? One of my favorite websites, USTreasurybond.com. USTreasurybond.com. This is such a, I'm sorry, I just misspoke. US Treasuries yieldcurve.com. And you can go to that site, you can enter the date that you want to know. What did the yield curve look like in 1981 when Paul Volcker was breaking the back of inflation? You can take a peek. It also allows you to compare and contrast 2 periods of time. And that's what I've done here by way of the red line. This is late in 2019, and I wanted to choose, I wanted to start this part of the talk by way of pre-COVID. Like, what was happening right before we were all thinking, this is kind of scary? And then what happened in the bond market when we knew what we were dealing with? And so the blue line is indicative of June of 2020. So let's go back to what happened before 2019. Remember 2008 to 2012, Bear Stearns went bankrupt. Lehman Brothers went bankrupt. I was at Merrill Lynch at the time, and in a hurried over-the-weekend sale, Stan O'Neill, who I believe was our CEO at Merrill, hurriedly put Bank of America into the arms of Ken Lay Ken Lewis. Ken Lay was Enron. Ken Lewis was Bank of America CEO at the time. That was a hurry up. I remember over the weekend calling a coworker, did you know that we just got sold? Anyway, so prior to 2019, we were cleaning up a mess since 2012. I think 2012 was QE1, where the government's just in there trying to support everything. And we're going to look at some of the ways they support things in just a minute. But from 2012 to 2019, the government's just in there doing the heavy lifting, trying to hold this thing together. And what's so interesting from an investor's perspective is we become desensitized to the nuances of the time, and it becomes the new normal. My fear is that investors may view, the decade of 2012 to 2020, maybe 2021, as normalcy. But bear in mind, the Fed was more active than it's ever been before in propping things up, and that's not normal. That's very abnormal. I'd say 2 standard deviations away from the norm. That's not even within the first standard. We usually don't have the Fed being active in the repo market. We'll get into that. Suffice it to say, when driving down the road of life, investors have a tendency to look in the rearview mirror and extrapolate that forward. And that's very problematic from the following perspective. What if the next 20 or 40 years looks completely different than the previous 20 or 40 years? So after after Paul Volcker broke the back of inflation in 1982, we subsequently had a 40-year rally in bond prices where interest rates were getting pushed lower, bond values were moving higher, and now there's potentially a decoupling of what's going to happen coming up versus what has happened. And those that invest as if this is going to be extrapolated forward, that could be really problematic. Now, I don't know that it's problematic. I'm just guessing that's a risk that is out there and investors want to get their mind around. Okay, let's get into it. So in late 2019, a 1-year government bond yield, not coupon, yield, because remember, a 1-year bond could have been, and I'm going to break my brain here, but a bond that was issued 19 years prior and was a 20-year bond at issuance is now a 1-year bond. And so all treasuries, because it's the same credit quality, regardless of coupon, regardless of issuance price, all treasuries are going to find parity based on yield. So whether it was issued as a 20-year bond 19 years before 2019, or whether it was a 2-year bond issued 1 year prior, at that point we were at 1.6 or 1.6% yield for a 1-year government bond. So regardless of price, regardless of coupon, they all lined up so that running towards maturity, it's a 1.6% yield. And you could find the same, you can do the same thing here by way of a 10-year bond or a 30-year bond. All 30-year bonds had this yield at that time. All 20-year bonds, I'm sorry, all 10-year bonds, 10 years of life left to them, had this yield at that time, et cetera, et cetera. Okay, let's look at what happened next. COVID happened. Nobody's running around, nobody's, you know, we all know what happened to COVID. The economy starts to do this. And so what happens to risk-free assets? They're pursued because the stock market is no longer exciting. And who would have thought that the stock market would double as the Fed comes in and gets just like on steroids with activity of support? But regardless, the yield curve collapsed. I just want to underscore, this is the yield curve. This is the yield curve compared at 2 points in time. Generally, when you're looking at the yield curve, there's only one line connecting all the yields for all maturities. But anyway, this is the yield curve in 2 points of time. Yield curve collapses, so that means the value of those assets go up in market value. And we've talked a little bit about what we've come from since 1980 to current, and I'll throw in there if you really want to nerd out on the availability of 401k plans to purchase private equity assets. Please email me. I wrote a paper on that. You can do a Google search on it. It was June of 2020. Congress allowed the Department of Labor to invest in private equity, and those assets find their way into a company 401k plan, be it Amazon, Microsoft, what have you, in the life cycle funds. And that's, just to put a bow on this, life cycle fund is a mutual fund that somebody can invest in where the 401k administrator tinkers with the asset allocation within the fund, but that investor just owns that one fund. And if they're 10 years away from retirement, so maybe it's a 2032 life cycle fund, the administrator will slowly change the risk profile of the holdings so that when the employee finally gets to retirement age, it's a risk appropriate asset allocation for that fund, regardless. Private equity investments, including syndicated self-storage assets, multifamily, office, and we're going to go to office today, that's the primary topic. Those assets can, as of 2020, were by the Department of Labor, which oversees ERISA, and ERISA oversees the 401k, 403b, 457 pension, you know. Anyway, that's when those assets really started to gain traction as an asset allocation class within life cycle funds. So when the yield curve collapses and you've got healthy assets that are able to be owned, that have good cash flow, you've got more investment dollars coming towards those assets, supporting those assets in price. Here's my point to the last 2 minutes. Just the way a U.S. government bond went up in value when the yield got pushed low, and it's actually, the mechanical process is the market value of the bond getting pushed up is what drives the yield down, because as the first point that we had, all bonds are issued and mature at $1,000. They can trade in valuation, but even if they go to a premium, they're still going to come down in the years prior to maturity and lose value. So they may have gone to $1,200 market value, but it's going to come due at $1,000. Anyway, the same mechanical process happens with commercial real estate of all types, provided that the credit quality is there to support that market value. Now, yes, you've got to be able to, I'm getting ahead of myself. I'm going to save that point till later in the talk. Anyway, that's the yield curve, a quick definition, and that's what happened when COVID happened. Let's take another look at 2 different periods of time. And Sean, I know I'm blocking you, so I'm going to step out of the way just a little bit. So here we are. The blue line is where we were a year ago. So a year ago, before we got into the inflationary pressures, and it was really the fourth quarter of 2022, I'm sorry, the fourth quarter of 2021, when we really started to get, inflation starting to pick up, the Fed started to get active, and subsequent, we know what the Fed has done. And the way we know what the Fed has done is we look at this, the wall on the left side of the chart here. This is what we hear people talking about the Fed funds rate, federal funds rate. So that is technically the Fed funds rate is the overnight interest rate. Banks charge each other for cash that's on deposit. Why is that important? Has to do with their Tier 1 capital ratio. We have one banker here in the room. Please go easy on me if I misspeak. I don't think I'm going to get over the end of my skis, but I know I'm on safe ground here. Fed funds rate is right here. It's the overnight interest rate, and that's the beginning of the yield curve. And the further the yield curve goes, you just look down at what's the time to maturity, and you know where you are on the yield curve. Anyway, this is where we were with the Fed funds rate I'm going to turn my back on you here, pardon me for that, on the 4th of 2022, January. So Fed funds rate was I don't know, that looks like 10 basis points to me, and the Fed funds, it's a target, it's a 25 basis point target. What's a basis point? It's 1/4%. I'm sorry, 25 basis points is 1/4%. A basis point is 1/100th of 1%. Anyway, we're at 0.1 here. Today we're at a 4.25 to 4.5 target is my recollection on the target rate. And then here's the yield curve for yesterday. I printed these off. Now this is, I'm going to step off the screen here. This is a chart of what the yield curve looked like yesterday, and you'll notice that the time to maturity is it's a different dynamic here on the x-axis. But note the following. This is the 6-month mark, and we're here. This is 4.8 for those of you online. And the 10-year is here, and that's a 3.8, something like that. So generally speaking, over time, if we look at if we wet our finger and say, generally speaking, what does the yield curve look like? Generally speaking, I had my left shoulder isn't in the best shape, but generally speaking, we have a line that looks like this. You know, the short term, the rate of return is low. The further out we go, the higher the rate of return. So it's very abnormal to have an inversion. So this is what people are talking about when they say the inverted yield curve. Generally speaking, we've got a 150 basis point spread between the 2-year and the 10-year. Generally speaking. Obviously not always, but generally speaking. This is just for kicks. I wanted to throw up what we looked like in 2007, and this is the 20-year, and in 2007 we were 5.3. Here we are at 1 year, and we were at 5. So 4.8 is Fed funds rate, and the peak in the curve was 5.3. I don't have anything of significance to add. It was just, I wonder what we were looking like in mid-2007, and there's the answer. Now for the gearheads, either in the room or online, there's a commodity firm, the CME Group, and I want to be really careful to get this right. C for Charlie, M for Mary, E for Edward, CME Group. If you go to their website, and then on the left side of the website, and for you online, this is left. There's just 3 categories down. There's a button called probabilities. So CME Group, and this is the Fed Fund Watch tool. Click on probabilities. It's going to take you to this chart. Let's talk a little bit about what this chart is representing. These are probabilities. So remember I mentioned that the federal funds rate, or the Fed funds rate, has a target. It's not a number, it's a target. The target here is 3.75 to 4, and this target gets higher the further to the right we go, and this column here is 5.5 to 5.75. These are the upcoming Federal Reserve meeting dates. February 1, March 22, etc. So these are the dates, and these numbers are probabilities. This is the options market, and how the options market is pricing the probability of the federal funds rate to be at a given interval. So let's call these columns, the target of 4 to 4 1/4, let's call that an interval. And so for the upcoming meeting, the options market, which is just all investors and it's implied volatility, and it's just all this Greek stuff rolled up that frankly I've spent so long I can't really remember what it all means. But there's a 0% chance, according to the options market, that the federal funds rate is at 4 to 4 1/4 in February. Now, the options market pricing is telling us that the federal funds rate has a 57% likelihood of being at 4.5 to 4.75 in February. What's the takeaway here? February, who really cares? Here's a question that investors are asking. Where will the Fed peak on the federal funds rate and then start to lower? And as of yesterday, this chart would say the Fed fund rate is likely to peak between 5 and 5 1/4 in May, June, and July, in that the recession, or a slowing of the economy, is going to cause the Fed to start to lower interest rates. Now, I don't want to get lost in the weeds here, but most economists that over the years I've followed have the perspective that it takes about a year and a half to 2 years for the economy to fully feel the effect of a Fed fund rate increase. The last year, the Fed has moved more emphatically. I think this is an accurate statement. The Fed has moved more emphatically in a shorter period of time than ever before. We're dealing with something we've never seen before, is my point. And it wouldn't surprise me if the Fed puts us into recession. That's a risk that's out there. That's not a prediction, but that's a risk that's out there. Okay, so how long ago? I mean, we know that 2008 was, what is that, 15, 16 years ago? It seems like forever because everybody has bought assets and they've gone higher, and a lot of investors will lever that up to a degree, either to a massive degree, we're going to look into that, or only to a little degree. But 2002, the pain of 2008 seems like a long time ago. We're going to start to layer on some concepts. DSCR stands for debt service coverage ratio. Now, if we put that into terms of home ownership, how might that play out? So, a lot of times you'll hear lenders say that on a home purchase, which by the way is subsidized by the government, I think home loans are the only environment where you can get a 30-year loan. Generally, it's a 5 to 10-year deal. Like banks aren't comfortable lending money for maybe if it's a life insurance company, they may lend for 10 years, but generally banks like 3, 5, maybe 7, but generally 5 years was what banks are comfortable with. So to put a DSCR, debt service coverage ratio, into home ownership type of terms, banks like to lend to a homeowner when it's a kind of a cookie cutter script. You got your income, you got your expenses. The home mortgage at most is 40% of the gross income. I think I'm right on that. So there's kind of a box, and banks are looking to see, someone that kind of looks like they fit the box, and so it's worth their risk. Well, with commercial loans, it's not a government subsidized loan, or at least exclusive of 2012 to 2022, when the Fed was really active at the repo window with the discount rate. But external to those factors, generally speaking, commercial loans are not subsidized by the government. So banks like to loan when the DSCR is 1.25, which means your NOI, $20 word, what does that mean? net operating income, when you're comfortably above the expense for the debt. That's what I'm trying to get to, a 25% profit margin cushion over and above the expense for the debt. Non-subsidized by the government, as we mentioned. Now, let's start to drill down just a little bit on areas of risk. And I want to preface my comments for the rest of our talk of this is not investment advice. I'm not saying this is going to happen. I'm saying from a layman's perspective, this really seems like there's some significant risk. And from the perspective of understand, evaluate, and put risk to work, these are the kinds of things where as an investor, you want to be fluid in knowing what those risks are. Office tenancy is down, full on. Lending rates are up, full on. So, and that's the obvious, everybody's seen that, everybody knows that, we all get that. The challenge becomes if a property was purchased 3 or 4 years ago and it's coming up for refinance because that loan is 5 years or 7 years or somewhere in the middle there, what happens when that thing needs to be refinanced? And we're going to spend some time on that as we just unpack the office space. My clicker is giving me some grief. Let's see if we can. Roy, I might need you to hit the enter button, and I'm not sure what I did here. I hear Roy saying he's going to. I wonder what I did. I can assure you online that I'm hitting, there we go. So thanks, Roy. So tenancy is down, lending rates are up. That creates a problem. That's where I'm going, is that creates a problem. Now, 6 or 8 months ago, I think I snipped the date on June 2nd of 2022. So, 7 months ago. Jamie Dimon, CEO of JP Morgan Chase. By the way, Dimon is very well regarded in the industry. He's one of the CEOs that didn't need to take TARP money, Troubled Asset Relief Program, going all the way back to Hank Paulson when Hank was the Secretary of the Treasury, and he made Dimon take the check because all the rest of the banks needed a check, and the CEOs didn't want us as the nation to know which bank was the most troubled. I'm going on memory from, golly, 15 years ago now. But anyway, Dimon is very well regarded, top shelf CEO. From Google, he advised to prepare for an upcoming economic hurricane. When that happened, I thought, what is he seeing that I'm not seeing? Didn't see, last summer, interest rates were up, but what was it that was so problematic, so cancerous? Sorry if any of you, my wife deals with cancer research, and maybe that's a very emotional topic, poorly chosen words. Regardless, a problematic industry by way of lending. What was it that he was seeing? I've got a notion, and we're going to just kind of peel the cover off this thing. So we'll get into it. Let's say there's a $100 million transaction. Late 2021, that transaction might be a 60% or a 65% loan. If we go back 15 years ago, before the 2008 to 2012 challenge, that may have been an 80% loan or even an 85% loan. We had some, Congress got involved when the banks got upside down and needed taxpayer money to support them. And so, you've got, oh heavens, out of Switzerland, I'm forgetting some legislation that has taken hold around the world, but then also Dodd-Frank, which came about before the Frank congressman retired. I think that was 2012 or 2011 when Dodd-Frank happened. But anyway, basically Congress told the banks, hey, you guys can't lend, you can't lever up as much as you have been. You've got to bring that leverage down a little bit for your own sake. The banks hate holding cash because the banks are good at selling time and making a bet on collateral. In 2008 to 2012, the banks got it wrong on the collateral, because remember the ninja loans, no income, no job, no asset. You could finance 95 or 98% purchase. You can't do that anymore, but I think what the banks have gotten wrong this time is the timing piece. We'll get into that in just a minute. Anyway, on the commercial side of things, the banks tend to borrow the majority of the money that they loan. Now, I'm a little bit out of my league for the next minute here. I kind of know what I'm talking about, but I kind of don't. We're going to talk about Tier 1, Tier 2, Tier 3 ratios. Tier 1 is fairly prescriptive. This is a busy slide. If you're seeing this online, you're not going to be able to get it. I put this up because on a replay, you'll be able to read this. By the way, this is being video recorded, and we include a link to the replay in our following communication. I think it'll go out Monday of next week. So if you want to do a little homework, Monday of next week, you can read through some resources. The one number I want to be captured here is this, buried down here in fine print. The Tier 1 capital ratio generally is 6% or more. Now, what does that mean? What that really means is that 6% of 100 million is $6 million of capital. So from my simpleton mind, $6 million needs to be held at the bank for a $100 million loan to be made. Sneak peek, the repo market is where banks and non-banks can go to sell that loan that they're holding on the books. And trillions of dollars on a daily basis, and that's a legitimate number, trillions of dollars on a daily basis gets marketed at, in the repo market, which really means commercial real estate isn't just owned by Columbia Bank, a local bank here in the Pacific Northwest, who is active in commercial real estate. So it's not just like Columbia is holding this loan. Likely, Columbia and most other banks are in the market trading these assets and borrowing against the assets. And so I've just kind of, we're going this way in time during this conversation. I'm giving you kind of a sneak peek to where we're going because I want that to germinate by way of how problematic is this. Anyway, a Tier 1 capital ratio, generally speaking, the low end is 6%. Obviously, the higher the capital the bank is holding, the less leverage and the less risky the bank's situation is. Okay, let's look at some other things. Non-bank financial company and repo market. We're going to look at these for the next couple of minutes. Currently, the market of loans, the loan portfolio for non-bank financial companies is $5 trillion. That's a big chunk of change. And as I teased just a moment ago, that's not necessarily owned by the bank that issued it. It's out there. It's kind of like if you put, when I was a kid, my mom we used to make peanut butter cookies, and she'd put some food coloring in, and it was fun to watch a pitcher of water, and it trickles down and it just permeates everything. That same notion is happening with non-bank financial companies. I mean, these assets get traded so much. Who knows who owns that thing? And we saw that back in 2008 to 2012. So who owns this kind of stuff? Mortgage REITs, private equity firms, hedge funds, debt funds, collateralized loan obligations, collateralized debt obligations, bridge lenders. The further away from the loan you get, the more abstract that the quality of that asset gets, because it's been parsed off and sold and resold, and the computers know where all that is, but to us as investors who are trying to understand and evaluate risk and decide where the best place to place capital and how to stack that capital and what sectors to be in and what's the maturity and how do I keep enough cash so that when I see an opportunity coming up maybe in 18 months or 2 years. You know, how do I get the best return on that cash, but also not jeopardize the risk or the liquidity anyway? This is a murky swimming pool to be playing in. We talked just briefly about Dodd-Frank. So it used to be the 65% of a, used to be that 85% of a loan could be levered. That's been squirreled down to maybe 70%. Spartan likes to be at 60%. You know, sometimes we'll squiggle up to 63%, maybe 65%. It's at one point over the last 4 or 5 years, but that's our sandbox. And the shadow banks. This is that $5 trillion market. Here's some resources that in the replay you can click on if you want to drill down more on this topic. Candidly, it's a little bit beyond me to act like an authority on that market. I'll let you do your own reading. Repo market. Let's talk about this. That's where over the last 5-6 years, the Treasury has tried to create tools to help lenders. So there's things now that are available to banks and non-bank financial companies that did not exist in 2007, 2005. And it has to do with liquidity. I'm going to call an audible here. I'm going to go off track. I didn't put a slide up on this topic, but you know how obviously the Fed has been raising interest rates. The Fed is also rolling off debt. And when you think about, okay, rolling off, what does rolling off debt mean? The Fed, via the repo market, had in the past, up until 8 or 9 months ago, they were in the market, so when a loan matured, they would come in and buy that. And so the bank has cash to go out and reloan and then scale that up again at, you know, your 6% Tier 1 ratio. Now, and that was a lot of the supporting of the marketplace. That's what makes lending work. Now, the Treasury is telling us we're rolling off, wait for it, on a monthly basis, $90 billion per month. They're sucking that liquidity back out of the marketplace. So when a loan comes due, as opposed to being there to buy the note to buy the note so that the bank can go out and make more loans, now the Treasury is letting the sum total of 90 billion mature. And so so they're pulling that liquidity back out of the marketplace. Now, if you've been around Spartan for the last 6 months or the last couple of years, you know that during 2022 we had 2 portfolios of loans that we struggled mightily to get refinanced, and we are not a sloppy shop by any stretch of the imagination. I think we're really buttoned up in the industry from a comparison perspective. We're really buttoned up. When I look at the banking environment, and I may not have been a banker, but I'm not new. I've been 30 years in the financial services industry this year. When I look at the banking industry, what I think happened in 2022, I don't think the banks had the cash to lend. I really don't. When the Treasury is rolling off 90 billion, when you've got office that is down in tenancy, up in lending, and you've got arguably the most widely respected bank CEO saying, get ready, there's a hurricane coming. To me, heavens, getting all tongue-tied. That tells me that the bank, from the investor perspective, looking in the rearview mirror, looking backwards, that whole ditty that we went through, what that tells me is the banks say, we're not sure which way this road ahead of us is winding, but things are looking, we're reeling in our risk appetite. We're holding on to as much cash. As we were getting started today, we were talking, before I started presenting, Someone here in the room mentioned, isn't it interesting what Elon Musk is doing by way of his office space for Twitter? I mean, he's not paying his mortgage anywhere. Salesforce is, what did Salesforce announce? 18,000 employees that they're laying off, or I think it was 8 or 10% of its workforce. So you get tenancy down, you got borrowing costs that are up, and you got a widely respected CEO saying, we're getting ready for a hurricane here. To me, that says the banks weren't lending. It wasn't that the asset wasn't deserving of a loan. And I can tell you ardently that in April of 2022, we had a bank saying, come to us, we love you, we're going to finance this thing. Here's your fixed rate loan, we love you. Boom, a week before closing or a couple of days before closing, they turned their back on us and said, we're not going to do this loan. In commercial real estate, you really have no recourse when you're the borrower. They either fund it or they don't. Anyway, it's been an interesting last 12 to 18 months. In the repo market, where we're talking about this $5 trillion pool of money, when you think about the interest rate, before late 2021, when the Fed really started to get active and they really jammed on the gas pedal, and I think the first rate increase was March of 22, but it used to be that the repo rate was 0.25. Banks don't sit on cash, and investors don't sit on cash. Deal sponsors don't sit on cash. As an investor myself in Spartan deals and other types of investments, I find myself oftentimes being critical of, okay, what's the equity multiple? That's just a big fancy way of saying, what factor of return am I going to get? Am I going to get a double, which would be an equity multiple of 2? Am I going to get a 50% rate of return, which would be an equity multiple of 1.5? And then, of course, the accompanying question, how long does it take me to get that? 5 years, typically, for a Spartan deal. So as investors, we're very attracted to the shiny fishing lure. Whatever glitters and it's the best rate of return, that's what we want. Well, in this lending pool for the hedge funds and the CLOs and the CDOs, everything was wound as tight as it could get. And it was priced on a 0.25 to a 0.50 Fed funds rate and discount rate. Discount rate matches Fed funds rate. I don't think I teased that out, but those two work together pretty closely. So maybe 10 minutes ago I mentioned that banks focus on time and asset quality. And so in the financial crisis 15 years ago, we mispriced the asset quality. I think what's breaking on us right now is us as investors and banks have been caught off guard by way of the time. That chart of the federal funds rate option pricing, I don't think anybody in late 2021, I don't think anybody was expecting the Fed funds rate to be at 4.5%, 4.75% in January of 2023. And in fact, our chief investment officer, Ryan Gibson, I think it was earlier this week or last week. No, it was at our December year-end update. He pulled out an article, and I'm pretty sure the article stated that the upper end of the range for the federal funds rate and the discount rate was priced at 1.75% in January of 2022. So the market's expectation was a peak of 1.75%-ish. And here we are at 4.5%, and we're not done. That's nutty. Anyway, so the repo market, it's wound pretty tight. And by way of banks, and all of us getting it wrong, I think banks got it right by way of the credit quality of the asset, and their leverage is, they might have borrowed, or they may have worked with a sponsor who is leveraging 60 or 65%, but it's that non-bank holding company, those specialty hedge funds, private funds, they're the ones, I think, that are going to be taking the shot in the arm and absorbing a loss, because they were priced very low discount rate, federal funds rate, and they're leveraging and leveraging and leveraging. And when a commercial office, which is JP Morgan's #1 asset class for its loan portfolio, when that asset comes time to mature and be paid off, If the tenancy is down, if the borrowing costs are up, where does that go? That goes to receivership via some kind of, I don't know what it is, Chapter 13 for a corporate bankruptcy or what have you. I'm a little bit out of my league on being sharp with the knowledge on this topic, but seemingly that goes to a receiver and it gets sold for 15 or 20 cents on the dollar. I just can't imagine. My best guess is there's some real risk in office space and it's deserving of careful attention. Anybody, this is a funny one. Anybody remember who Robert Citron is? Orange County, California, 1993. So, yeah, full on. So, the comment was, didn't Orange County go into receivership? And so here's the backstory, and yes, it did. Here's the backstory. Early 90s, I think it was 1993, I walk into the downtown office on Wall Street, and there's two groups of brokers chatting, and that's abnormal for 6:15 in the market. Generally, we're all trying to consume as much coffee as we could and didn't want to talk to anybody until at least 7 o'clock. And here's clusters of people. So what's going on? So Robert Citron was a treasurer of Orange County, California, and he had the municipal bond portfolio, and he was borrowing against the bond portfolio. And he'd go to one Wall Street firm and borrow a bit, and then he'd go to another Wall Street firm and borrow a bit. And he had that thing wound as tight as it could go. He was looking like a rock star in the world of being a treasurer of a county. He was killing it until rates went up in this must have been 1994, because that's when rates started to go up. And the county went bankrupt because the borrowing costs got so high. The receipts for the government, or for the county, couldn't pay the expense of the borrowed funds, and Orange County, California went bankrupt. That's bananas, but it happens. And my point is, as investors, the banks are probably going to be okay as we work through an office, restructuring. I think there's probably some opportunities for multifamily in a receivership to move in and pick up some properties that roll through this. We can't refinance, and subsequent to this, as this thing starts to play out, there gets to be a point where the property going into receivership is now the comparable sale that the bank, I think the bank would have to use. So I'm not sure that, I don't understand totally how comparable sales works, and I don't understand all that well, other than to say you get enough receivership activities underway, and I'm guessing that is going to count in one of the appraisals that needs to be done. And kids, that's when we're really into the soup on office and the refinance ability for these intermediaries. I can tell I have a tendency to start talking and then I talk too much, and I think I've gotten a little bit ahead of myself. Let's just catch up here. Yeah, here's where we're going to end my comments today. The real issue on this deal is magnitude. So again, 15 years ago, the banks we missed by way of the credit quality of the housing market. So and a lot of volatility there. The magnitude to me means how long does the federal funds rate stay high, which is what is going to compound the rates charged at the discount window, and that affects the amount of write-down that an intermediary or a bank needs to have, which is a charge against equity, which constricts the ability to make a loan. Now, a few minutes ago, I talked about 2022 being a challenging time to get a loan. I think that was the bank's appetite for risk, and they were forward-looking. Jamie Dimon, Hurricane. As we start taking write-downs and charge-offs, that brings the capital stack or the equity of the bank down, and so the appetite may be there, but the cash won't be there. So thank you so much for joining us this afternoon with Spartan Investment Group for our January First Friday meetup. We do these monthly. We make them available via recorded session. Please think of us and come back again as you're looking to both understand and evaluate risk when it comes to private investments. Thanks so much. Take care. Thank you all for